Now, I'm going to let you in on a secret that people pay tens of thousands of dollars for in consultations, but I'm going to tell you for free. Crises. This word scares everyone. It scares us because crises have major consequences and many people suffer from them. Today, we will learn how to use crises as an opportunity to become richer. And we will also explain clearly how rich people always use them. We will talk about the stocks of companies that are falling rapidly and why, when prices are so low, is it the best investment to buy them? Also, what should you do when there is a crisis and many businesses are suffering from it? Because this is the best time for you to realize your potential. So, let's start with a short introduction. There is a moment that terrifies most people. A moment when headlines scream disaster. Markets fall, businesses close, jobs disappear. Fear spreads faster than facts. It is the moment when the economy begins to crack, a crisis. And in those moments, something fascinating happens. While millions panic, while millions rush to protect what little they have, a small group of people quietly begins preparing for something very different. Opportunity. This audiobook is about that moment, about the hidden pattern behind every economic collapse. Because if you study history carefully, you'll notice something remarkable. Every major financial crisis created two very different outcomes. For most people, it destroyed wealth. But for a few, it created it. The 2008 financial crisis wiped out trillions of dollars. Entire industries collapsed. Homes were foreclosed. Savings disappeared. Yet during that same period, some investors made fortunes. Businesses were acquired for pennies on the dollar. Stocks that once traded at $100 fell to $20. Companies with strong fundamentals became temporarily undervalued, and those who understood the game began quietly buying. The same pattern appeared again during the pandemic. Markets crashed. Fear dominated the headlines. People rushed to sell their investments. But within months, markets began recovering. And the individuals who bought during the panic saw enormous gains. This is not luck. It is a strategy the wealthy have used for centuries, a strategy built on one simple truth. Crisis creates distortion. Prices stop reflecting true value. Fear replaces logic, and the gap between value and price becomes enormous. The average person sees danger. The wealthy see discounts. The average person retreats. The wealthy prepare. The average person sells. The wealthy buy. But this behavior doesn't come naturally because crisis triggers powerful emotions: fear, uncertainty, panic. And those emotions push people toward decisions that feel safe in the moment, but costly in the long run. Think about it. When the world feels unstable, the natural instinct is to protect yourself, to pull back, to hold on to whatever you have. This instinct helped humans survive for thousands of years. But in financial markets, it often leads to the worst possible decisions. Selling at the bottom, buying at the top, reacting emotionally rather than strategically. The wealthy train themselves to think differently. They prepare before the crisis begins. They understand economic cycles. They build reserves. They study history. So when panic arrives, they already know what to do. And that preparation makes all the difference because crisis moves fast. Prices fall quickly. Opportunities appear and disappear within months, sometimes within weeks. If you wait until the panic begins to learn the strategy, it's already too late. This audiobook will show you the strategy behind those moments, the mindset, the preparation, the actions, the timing, the psychology, everything the wealthy understand about crises that most people never learn. But before we explore the strategy, we must understand something deeper: why crises happen at all. Because financial collapse is not random. It follows patterns, cycles, human behavior repeating itself again and again. And once you understand those cycles, you stop fearing crises. You start preparing for them, because every economic collapse contains the seeds of the next great fortune. And in the next chapter, we explore the pattern that reveals exactly when those moments begin, the cycle that has repeated for centuries, and the warning signs that tell you when the next crisis is approaching. Dear viewer, we strive to create high-quality videos for you. Please assist us in improving our efforts by commenting on what you like about the video and what you would change or add. We would be very grateful. Chapter 3. The Cycle. Most people never notice. To understand how wealth is created during a crisis, you must first understand a simple truth about the economy. Boom and bust are not accidents. They are cycles. Cycles that repeat over and over again. Different years, different industries, different headlines, but the same pattern. At the beginning of every economic cycle, something exciting happens. A new opportunity appears, a new technology, a new financial innovation, a new market expansion. Confidence grows, money begins flowing, businesses expand, jobs increase, optimism spreads. At first, everything makes sense. Growth is real, productivity increases, investments pay off. The economy genuinely improves, but then something subtle begins to change. Success attracts attention. Attention attracts speculation, and speculation attracts excess. Prices start rising faster than value. Investors begin chasing profits. People start buying assets not because they understand them, but because everyone else is doing it. This phase is called euphoria, the most dangerous phase of any economic cycle, because during euphoria, risk becomes invisible. People stop asking hard questions. They assume prices will keep rising forever. They assume the good times will never end. History is filled with examples. The dot-com bubble, the housing bubble, the cryptocurrency mania. Even centuries ago, during the tulip mania in the Netherlands, rare flower bulbs sold for prices higher than entire houses, all driven by the same force, human psychology. And when enough people believe prices can only go up, something fragile begins forming, a bubble. Bubbles can grow for years, sometimes longer. During that time, wealth appears to multiply rapidly. New millionaires emerge. Stories of overnight success dominate the news. Everyone feels like a financial genius. But underneath that excitement, the system becomes unstable. Debt increases, speculation grows, prices detach from reality, and eventually, something triggers the correction. Sometimes it's a small event, an interest rate increase, a failed company, a geopolitical shock. Other times, it's something larger, a financial collapse, a banking crisis, a global pandemic. The trigger is often unpredictable, but the result is always the same. The bubble bursts, fear spreads, and prices fall. Fast. This moment is what most people call a crisis, but from a different perspective, it is simply the reset phase of the cycle, the moment when excess disappears. Weak businesses collapse, speculation evaporates, and prices return closer to reality. For the unprepared, this moment feels catastrophic. Savings shrink, jobs disappear, confidence collapses. But for those who understand the cycle, this moment represents something very different: opportunity. Because during the panic, markets rarely behave rationally. Assets become undervalued. Companies with strong fundamentals trade at absurd discounts. Entire industries temporarily collapse in price, not because their long-term potential disappeared, but because fear overwhelmed logic. And that gap between price and value is where fortunes are built. The wealthy do not wait for perfect conditions. They wait for distorted conditions. Moments when panic creates opportunities invisible to everyone else. But to take advantage of those moments, preparation is essential. Because when the crash begins, most people are financially fragile. They have no savings, no liquidity, no flexibility. They are forced to survive rather than invest. The wealthy prepare differently. They build reserves. They reduce risk before the crash. They study market cycles. They position themselves to act when others cannot. And that preparation is what we explore next. Because the real strategy for getting rich during a crisis begins long before the crisis arrives. The wealthy prepare years in advance, quietly, patiently, waiting for the moment when fear spreads across the market. In the next chapter, we reveal the first rule the wealthy follow before every major economic downturn. A rule that determines who survives a crisis and who emerges from it richer than ever. Dear viewers, write which city you're from. It's interesting to see which corners of the world are watching our videos. Chapter 5. The first rule before every crisis, before every financial collapse, before every market crash, before every economic panic. The wealthy follow a rule most people never even consider, a rule that determines whether a crisis destroys you or elevates you. The rule is simple, but it requires discipline. Always prepare during prosperity. The biggest mistake people make is believing the good times will continue forever. When markets rise for years, when businesses grow, when the economy feels strong, people assume stability is permanent. They expand their lifestyle. They increase their debt. They build financial lives that only work if everything stays perfect. And that assumption is incredibly dangerous because economic cycles are inevitable. Boom always leads to bust. Growth always leads to correction. And prosperity always carries the seeds of the next crisis. The wealthy understand this, which is why they prepare before the storm arrives. Not during it, before. Preparation begins with liquidity. Liquidity means having access to cash or easily deployable capital. Because during a crisis, the greatest opportunities appear suddenly. Assets become undervalued overnight. Businesses sell for fractions of their previous value. Markets drop dramatically, and only those with liquidity can act quickly enough to capture those opportunities. Think about the investors who became wealthy during the 2008 crisis. Many of them had spent years building reserves. When banks collapsed and markets crashed, they didn't panic. They bought properties, stocks, companies, entire industries trading far below their real value. But liquidity requires sacrifice. It requires resisting the temptation to spend every dollar during good times. It requires patience. It requires discipline. Because holding cash during a booming economy can feel uncomfortable. When everyone around you seems to be getting richer, when markets keep rising, when the media celebrates constant growth, holding reserves feels like missing out. But the wealthy see it differently. They see reserves not as idle money, but as future opportunity. They understand something most people ignore. The biggest profits rarely appear during stable times. They appear during chaos, during collapse, during panic, And that is when liquidity becomes power. Power to buy, power to negotiate, power to acquire assets that would normally be out of reach. But preparation goes beyond money. The wealthy also prepare mentally, because crises test emotional strength. When headlines scream disaster, when markets drop rapidly, even experienced investors feel fear. But the difference between the wealthy and everyone else lies in how they respond to that fear. The average person reacts emotionally. They sell investments. They withdraw from the market. They seek safety. But the wealthy expect fear. They plan for it. They know panic will spread, and they position themselves to act rationally when others cannot. This mental preparation creates an enormous advantage, because when the crash arrives, most people are frozen, overwhelmed, uncertain. While the prepared few already know their strategy. They know what they want to buy. They know the prices they're waiting for. They know which industries will recover. They know which assets will rebound. And that clarity allows them to act quickly. Preparation also includes knowledge. Studying history, understanding economic cycles, recognizing patterns, because once you understand how previous crises unfolded, you begin seeing the warning signs of the next one, and that awareness transforms fear into readiness. You stop asking, how do I survive the crisis, and start asking, how do I position myself to benefit from it? But preparation alone is not enough, because when the crisis actually arrives, another challenge appears, one far more powerful than market volatility, human psychology. Because during a crisis, the world becomes loud, negative, overwhelming, and resisting that emotional pressure becomes one of the hardest challenges any investor will face. In the next chapter, we explore the psychological battlefield of a financial collapse, why intelligent people make terrible decisions during crises, and how mastering your mindset becomes the most powerful wealth-building skill you can develop. Chapter 7. The Psychology of Panic. When a financial crisis begins, the numbers are not the most dangerous thing. The charts are not the biggest threat. The headlines are not the real enemy. The real danger is psychology, because the human brain was never designed for financial markets. It was designed for survival, for reacting quickly to threats, for escaping danger. And when the economy collapses, the brain reacts exactly the same way it would react to a predator in the wild. Fight, flight, or freeze. Investors panic. They run. They sell. They abandon long-term strategy in favor of short-term safety. And this reaction is incredibly powerful, because during a crisis, fear spreads like wildfire. Turn on the news. Every channel repeats the same message. Markets are crashing. Banks are unstable. Companies are collapsing. The economy is uncertain. The future looks dangerous. Your brain absorbs this information, and without realizing it, your instincts take control. You begin thinking about protection, about survival, about reducing risk at all costs. But in financial markets, this instinct often leads to the worst possible timing. Selling when prices are already low. Avoiding investments when opportunities are greatest. Missing the recovery that follows the crash. History shows this pattern repeatedly. During major market crashes, the average investor sells near the bottom, then waits too long to reinvest, often returning only after prices have already recovered. This emotional cycle destroys enormous amounts of potential wealth, not because people lack intelligence, but because emotions overpower logic. The wealthy train themselves to resist this reaction, not by eliminating fear, but by understanding it. They expect panic. They anticipate emotional pressure. They know the world will feel chaotic during a crisis. And because they expect it, they are less likely to be controlled by it. Think about professional firefighters. When a building catches fire, they don't panic. They move with calm precision. Not because fire isn't dangerous, but because they have trained for that moment. They have seen it before. They understand the environment. They know exactly what to do. Wealthy investors approach crises the same way. They study history. They analyze previous crashes. They understand market behavior during panic. And this knowledge creates emotional stability because what feels like chaos to most people feels like a familiar pattern to them. For example, during nearly every major market crash, something remarkable happens. Markets drop rapidly, sometimes dramatically, but eventually they recover, not instantly, not smoothly, but consistently. Every major crisis in modern financial history has been followed by recovery. The Great Depression, the 1970s inflation crisis, the 1987 crash, the dot-com bubble, the 2008 financial crisis, the pandemic crash. Each time, panic dominated the headlines. Each time, investors feared the worst. And each time, the economy eventually stabilized and markets moved forward. This does not mean every company survives. Many fail. Entire industries sometimes disappear, but the broader economic system adapts, innovates, rebuilds, and grows again. Understanding this pattern is critical, because when you realize crises are temporary, your perspective changes. Fear loses some of its power, panic becomes easier to resist, and patience becomes possible. But emotional discipline alone is not enough. You also need a strategy, a clear framework for deciding what to buy, when to buy, and how to evaluate opportunity during chaos. Because not every falling asset is a good investment. Some businesses collapse permanently. Some industries never recover. Some opportunities are illusions, which means the real skill of getting rich during a crisis is not simply buying when prices fall. It is knowing what deserves to be bought. And that is where the wealthy apply one of their most powerful tools, a concept that separates amateurs from strategic investors, a concept called value. In the next chapter, we explore how wealthy investors identify true value during a market collapse, how they distinguish between assets that are temporarily discounted and those that are permanently broken. Because in every crisis, some investments disappear forever, while others become the foundation of extraordinary wealth. Dear viewers, please write in the comments what assets you buy or are interested in. Perhaps these are stocks or maybe cryptocurrency. It is interesting to see how you structure your investment portfolio. Also, please write what you think about real estate. Is it still relevant to buy flats today? Chapter 9, Price versus Value, the hidden opportunity. When markets collapse, something strange happens. Prices move violently, stocks fall, properties lose value, businesses shrink, entire industries look broken. To the average observer, it feels like wealth is disappearing. But experienced investors see something different. They see a disconnect, a gap forming between price and value. And inside that gap lies the opportunity. Price is what people are willing to pay today. Value is what something is actually worth over time. During stable periods, price and value often stay close together, but during a crisis, emotions distort the market. Fear spreads faster than analysis. People sell not because the asset lost its real potential, but because they are afraid of losing more, afraid of uncertainty, afraid of the unknown future. When millions of people sell out of fear, prices drop rapidly, sometimes far below the real value of the asset. And that is where the wealthy begin looking. Not for assets that are popular, not for investments everyone is talking about, but for assets that are misunderstood, oversold, or temporarily ignored. Imagine a company that earns billions of dollars every year. Its products are used worldwide. Its customers are loyal. Its technology is strong. Then a crisis hits. Markets fall. Investors panic. And suddenly that company's stock price drops by 40%. Did the business lose 40% of its long-term value overnight? Usually not. But the price says it did. And that difference between price and value creates opportunity. This is the foundation of crisis investing. Not gambling, not speculation, not chasing hype, but identifying assets whose long-term value remains strong while their price temporarily collapses. The wealthy spend enormous time studying this distinction. They analyze businesses, they examine balance sheets, they study industry trends, they understand competitive advantages, because when panic hits, they want to know exactly what they are looking at. Without this knowledge, falling prices are dangerous, because some companies truly are broken. Some businesses cannot survive economic collapse. Some industries disappear. Buying blindly during a crash is not investing. It is gambling. But when you understand value, falling prices become clarity. You can recognize when the market is wrong. You can recognize when fear is exaggerating reality. And that clarity gives you the confidence to act. Warren Buffett once described this philosophy perfectly. He said that markets are driven by two emotions, fear and greed. When greed dominates, prices become inflated. When fear dominates, prices become depressed. And intelligent investors learn to do the opposite of the crowd. They become cautious when others are greedy, and bold when others are fearful. But that boldness requires patience, because crisis opportunities rarely appear instantly. Markets usually fall in stages. First comes the shock, then the panic, then the slow realization that recovery may take time. During this period, prices fluctuate wildly. News becomes unpredictable. Confidence disappears, and patience becomes one of the most valuable skills an investor can possess. The wealthy rarely rush. They observe, they analyze, they wait for the right moment. Because during crises, timing matters. Buying too early can expose you to unnecessary losses, but waiting too long can cause you to miss the greatest opportunities, which means the real art of crisis investing is learning to recognize when panic reaches its peak. The moment when fear becomes irrational, when markets begin selling assets indiscriminately, when headlines become overwhelmingly negative, when confidence disappears almost completely. That moment often feels terrifying. It feels like the worst possible time to invest. And yet, historically, it has often been the best. But there is another factor that determines who can take advantage of those moments, a factor even more important than timing, even more important than knowledge, even more important than courage. Position, your financial position when the crisis begins. Because opportunity is meaningless if you are unable to act. And that is exactly why the wealthy structure their financial lives differently. Not just to grow wealth during good times, but to survive and thrive during bad times. In the next chapter, we explore how the wealthy position themselves before crises, how they structure debt, assets, and cash reserves in a way that turns economic chaos into strategic advantage, because the real secret to getting rich during a crisis begins years before the crisis ever arrives. Chapter 11, Positioning Before the Collapse. By the time a crisis appears on the news, it is already too late to prepare. Markets move quickly. Fear spreads faster than logic. Prices fall before most people understand what is happening. And those who waited for confirmation suddenly realize they are reacting instead of acting. This is why the wealthy follow a very different strategy. They prepare before the collapse begins. Preparation starts with one powerful question. If the economy crashed tomorrow, would I be ready? For most people, the honest answer is no, because their entire financial life depends on stability. A steady job, stable markets, predictable income, rising asset prices. If any of those things disappear, the system collapses. The wealthy design their financial lives differently. They assume instability will eventually happen, not because they are pessimistic, but because history proves it always does. And this assumption changes how they structure everything: their cash reserves, their investments, their debt, their opportunities. One of the first things they build is financial flexibility. Flexibility means the ability to adapt quickly when conditions change. It means having enough liquidity to survive disruptions, enough savings to endure uncertainty, enough freedom to make decisions without desperation. Without flexibility, crises force people into terrible decisions. Selling investments at the worst possible moment, accepting unfavorable deals, abandoning long-term plans just to survive short-term pressure. Flexibility protects you from those traps, because when your survival is secure, you can think strategically. You can evaluate opportunities calmly. You can act when others are forced to retreat. Another key element of positioning is risk management. The wealthy rarely gamble everything on a single outcome. They diversify. They spread investments across industries, across asset types, across time horizons. Diversification does not eliminate risk, but it reduces the chance that one failure destroys everything. And during crises, that protection becomes incredibly valuable, because when one sector collapses, another may remain stable or even grow. For example, during economic downturns, some industries shrink dramatically: luxury goods, travel, high-end retail. But other sectors remain resilient: healthcare, essential services, infrastructure, technology platforms that people rely on daily. Understanding these differences allows strategic investors to adjust their portfolios, reducing exposure to fragile sectors, increasing exposure to resilient ones, positioning themselves before the storm arrives. But perhaps the most powerful preparation is psychological, because crises are not only financial events, they are emotional events. They test patience, confidence, and mental strength. The wealthy prepare their mindset long before the crisis begins. They remind themselves that markets fluctuate, that fear is temporary, that opportunities appear during chaos. This mindset allows them to stay calm when others panic, and that calmness becomes an enormous advantage. But positioning alone does not create wealth. Preparation must eventually turn into action. And when the crisis finally arrives, the real test begins. Because the moment of greatest opportunity is also the moment of greatest fear. The headlines will scream catastrophe. Experts will predict disaster. Panic will dominate the conversation. And in that moment, the prepared investor must decide whether to follow the crowd or follow the strategy. In the next chapter, we explore the moment when opportunity finally appears, the exact phase of the crisis when assets become deeply undervalued, the moment when the wealthy begin quietly building positions while the rest of the world is still running for the exits. Friend, write your opinion on this topic in the comments. Do you agree with us or not? I'm interested to hear your thoughts. Chapter 13. When Panic Peaks. There is a specific moment in every crisis, a moment when the fear reaches its highest point, when confidence disappears, when the headlines become overwhelmingly negative, when investors feel certain the situation will only get worse. That moment is called peak panic, and ironically, it is often when the greatest opportunities appear. Peak panic does not feel like opportunity. It feels like chaos. Markets may be falling rapidly. Companies may be announcing layoffs. Banks may be tightening lending. Experts may be predicting years of economic pain. And in that environment, optimism feels almost irrational. But history reveals something remarkable. When panic reaches its maximum intensity, markets are often close to their lowest point, not because the economy instantly recovers, but because prices have already adjusted to the worst expectations. By the time the news becomes universally negative, most of the selling has already happened. Think back to past crises. During the financial collapse of 2008, the headlines predicted a global economic disaster. Banks were failing, housing markets were collapsing, unemployment was rising. The fear felt endless. Yet the stock market reached its bottom in March of 2009. And from that moment forward, a historic recovery began. The same pattern appeared during the pandemic crash. Markets plunged in early 2020. News outlets warned of economic devastation. Entire industries shut down overnight. But within months, markets began recovering, and investors who purchased assets during the panic experienced extraordinary gains. This pattern exists because markets are forward-looking. They do not wait for good news. They begin recovering long before the headlines improve, which means the best opportunities rarely appear when everything feels safe. They appear when everything feels uncertain. But recognizing peak panic requires emotional discipline, because the environment will feel hostile to optimism. Friends may warn you not to invest. Experts may predict deeper losses. The media may highlight worst-case scenarios. And resisting that collective fear requires conviction. This is why preparation matters so much. Investors who studied history understand that panic eventually fades. They recognize the pattern. They know markets overshoot both on the way up and on the way down. And when fear pushes prices too far below value, they begin acting. But they do not act recklessly. They move strategically, carefully, gradually, because even during peak panic, markets remain volatile. Prices may continue fluctuating, new information may emerge, and patience remains essential. Instead of investing everything at once, many experienced investors build positions over time, buying in stages, adding more as prices stabilize, allowing uncertainty to settle before committing fully. This strategy reduces risk while still capturing opportunity. But peak panic offers more than just discounted investments. It also reveals something important about human behavior. It exposes how strongly emotions influence financial decisions, how fear can drive intelligent people toward irrational choices, and understanding this psychology gives you a tremendous advantage, because when you recognize the emotional patterns behind market movements, you stop reacting to noise. You start analyzing fundamentals. You separate temporary panic from long-term value. And that perspective allows you to see opportunities others miss. But there is another strategy the wealthy use during crises, a strategy even more powerful than buying undervalued assets, a strategy that multiplies opportunity when prices collapse. And that strategy involves something most people fear during recessions: debt. In the next chapter, we explore how strategic investors use debt differently during economic crises, how they turn borrowing into a tool for acquiring assets, and why the intelligent use of leverage has built many of the largest fortunes in history. Chapter 15, The Strategic Use of Debt. For most people, the word debt carries a negative feeling. Debt feels dangerous, stressful, restrictive, something to avoid. And in many cases, that instinct is correct. Consumer debt, credit cards, high-interest loans, impulsive borrowing can destroy financial stability. But the wealthy see debt through a completely different lens. To them, debt is not simply a burden. It is a tool, and like any tool, its power depends on how it is used. During a crisis, this tool becomes incredibly important, because when asset prices fall dramatically, opportunities appear that require capital. Sometimes large amounts of capital, and even wealthy investors rarely keep all their wealth in cash. Much of their wealth is tied up in businesses, investments, and assets. So instead of selling valuable assets to raise money, they often borrow. But they borrow very differently from the average person. They borrow with a clear purpose: to acquire assets that will generate more value than the cost of the debt. This is called productive debt, debt used to purchase something that produces income or appreciates over time. Imagine this scenario. A real estate property worth $1 million suddenly drops to $700,000 during recession. The building still produces rental income. The neighborhood remains strong. The long-term value remains solid. But panic in the market has pushed the price down. An investor sees the opportunity. Instead of paying the entire amount in cash, they borrow part of the purchase price, perhaps financing half of the property through a loan. If the property continues producing rental income, that income can cover the loan payments. Over time, the debt decreases while the property value recovers. Eventually, the investor owns a valuable asset that was purchased at a discount using borrowed capital. This principle has been used for generations. In real estate, in business acquisitions, in large investment strategies. Because debt can multiply purchasing power. It allows investors to control larger assets than their cash alone would permit. But leverage is powerful and dangerous. When used recklessly, it amplifies losses. When used intelligently, it accelerates wealth creation. The difference lies in discipline and understanding risk. The wealthy rarely borrow blindly. They analyze the asset carefully. They examine cash flow. They consider worst-case scenarios. They ensure that even if conditions worsen, the investment can survive. For example, responsible investors ask questions like, will the asset generate income during difficult times? Is the loan interest manageable? Do I have reserves if the investment struggles temporarily? What happens if the recovery takes longer than expected? This cautious approach prevents leverage from becoming a trap. Instead, it becomes a strategic advantage, especially during crises when lenders become cautious and opportunities become rare. But debt is not the only leverage the wealthy use. There are other forms of leverage even more powerful. Leverage created through knowledge, through systems, through networks, through time. Because wealth during a crisis rarely comes from a single investment, it comes from systems of opportunity, from positioning yourself in environments where multiple advantages combine. In the next chapter, we explore the concept of financial leverage beyond money, the invisible forces that allow the wealthy to move faster, think clearer, and capture opportunities others never even see. Because the real strategy behind getting rich during a crisis is not just capital. It is leverage in all its forms. Chapter 17, The Hidden Forms of Leverage. When most people hear the word leverage, they immediately think about money, borrowing capital, using loans, financing investments. And while financial leverage can be powerful, it is only one piece of the puzzle. The truly wealthy understand something deeper. The greatest fortunes in history were not built on money alone. They were built on systems of leverage. Leverage is simply the ability to produce greater results with less effort, to multiply your impact, to scale your opportunities. And during a crisis, leverage becomes incredibly powerful. Because while most people are overwhelmed by uncertainty, those with leverage move faster, think clearer, and act more effectively. One of the most powerful forms of leverage is knowledge. Knowledge about markets, about industries, about economic cycles. Because when chaos begins, information becomes incredibly valuable. Those who understand the environment can identify opportunities quickly, while those who lack knowledge remain confused. Imagine two investors during a market crash. Both see the same falling prices, but one understands the industry deeply. They know which companies are financially strong, which competitors are struggling, which technologies will dominate the future. The other investor only sees fear, news headlines, market volatility. Without knowledge, every investment looks risky. With knowledge, certain opportunities become obvious. This is why wealthy investors spend years studying industries. They analyze business models. They track economic indicators. They build expertise in specific sectors. Because when crisis hits, they want clarity. Another powerful form of leverage is networks, the relationships you build throughout your life, your connections with entrepreneurs, investors, industry leaders, advisors. During stable times, networks create opportunities, but during crises, they become even more valuable because information travels through networks faster than through the news. Deals appear privately before they reach public markets. Partnerships form quickly between people who already trust each other. Many of the largest crisis investments in history were never announced publicly. They were negotiated quietly between investors who already knew each other, between companies seeking capital and individuals capable of providing it. If you are connected to those networks, you see opportunities early. If you are not, you may never know they existed. Time is another form of leverage, the ability to think long-term. While most people are focused on surviving the next month, the wealthy think about the next decade because crises are temporary. But assets acquired during crises can produce value for decades. This perspective transforms decision-making. Instead of asking, Will this investment recover next year? They ask. Will this asset be valuable 10 years from now? If the answer is yes, short-term volatility becomes less frightening, and long-term opportunity becomes clear. Technology also creates leverage. Modern investors can analyze markets instantly, research companies globally, communicate across continents, access data that previous generations never had. But technology alone does not create advantage. What matters is how intelligently it is used. The wealthy combine technology with knowledge and networks, creating systems that allow them to move quickly when opportunity appears. All of these forms of leverage combine during a crisis. Knowledge reveals opportunity. Networks reveal access. Capital provides action. Time provides patience. Technology accelerates analysis. When these elements work together, opportunity multiplies. And that multiplication is how wealth is built during chaotic periods. But there is another principle that separates those who grow wealthy during crises from those who simply survive them. A principle that determines whether opportunity becomes lasting wealth. That principle is ownership, because the wealthy rarely focus on short-term profits. They focus on owning assets. Assets that continue producing income long after the crisis ends. Assets that grow in value over time. Assets that compound wealth year after year. In the next chapter, we explore the concept of ownership during crisis. Why the wealthy focus on acquiring assets instead of chasing quick gains. And how this mindset turns temporary opportunities into permanent financial power. Chapter 19. Ownership is the real goal. During a crisis, many people focus on survival. They worry about their job, their savings, their immediate financial security. And those concerns are completely understandable. But the wealthy are thinking about something very different. They are thinking about ownership. Because the true purpose of investing during a crisis is not quick profits. It is not short-term trading. It is not chasing temporary price movements. The real goal is acquiring assets. Assets that will produce income. Assets that will appreciate in value. Assets that will continue generating wealth long after the crisis ends. Ownership changes everything. When you own assets, you are not simply earning money. You are building a system that produces money for you, a system that continues working even when you are not. Think about businesses. When someone owns a successful company, that business generates income every day. Customers purchase products. Services are delivered. Revenue flows continuously. The owner does not need to trade time for money in the same way employees do. The system itself produces value. The same principle applies to many other assets. Rental properties produce monthly income. Stocks in strong companies generate dividends. Digital platforms create recurring revenue. Intellectual property produces royalties. During a crisis, many of these assets temporarily lose market value. Prices fall. Investors panic. But the underlying income-producing ability often remains intact. For example, imagine an apartment building. The economy enters recession. Property prices fall, but people still need housing. Tenants still pay rent. The building continues producing income even while its market price temporarily declines. This is why wealthy investors focus on income-producing assets during crises, because those assets create stability. They generate cash flow even when markets fluctuate. They provide financial resilience, and when the crisis eventually passes, those same assets often recover in value. creating both income and appreciation. But ownership requires patience, because building an asset portfolio takes time. It takes discipline. It requires reinvesting profits, allowing growth to compound year after year. Compounding is one of the most powerful forces in wealth creation. Small gains accumulate. Income produces more income. Assets generate additional assets. Over time, the system becomes self-sustaining. This is why many wealthy individuals appear to accelerate financially later in life, not because they suddenly became smarter, but because compounding finally reached its powerful phase, where growth begins accelerating dramatically. Crises can accelerate this process, because assets purchased during downturns often recover significantly. Those discounted investments become the foundation of future wealth. But there is a final principle that separates those who simply invest during crises from those who build extraordinary wealth. And that principle is vision. Because while most people see crisis as destruction, the wealthy see transformation. They see industries evolving, new technologies emerging, new economic structures forming. They look beyond the panic and ask, what will the world look like after this crisis ends? Those who answer that question correctly position themselves at the front of the next economic wave. They invest in the future, while others remain focused on the past. And that forward-looking vision has created some of the greatest fortunes in history. In the next chapter, we explore how crises reshape industries and create entirely new opportunities, why economic collapse often becomes the birthplace of innovation, and how identifying these emerging trends can place you directly in the path of the next great wave of wealth. Chapter 21. Why every crisis creates a new economy. Every crisis destroys something. Companies collapse, industries shrink, old business models disappear. At first glance, this destruction looks tragic, and in many ways, it is. Jobs vanish, savings disappear, communities struggle. But underneath this destruction, something else begins happening, something powerful, reinvention. Because every crisis forces the economy to evolve. Weak systems collapse, outdated industries shrink, inefficient companies disappear, and new ideas suddenly have space to grow, space that did not exist before the crisis. History proves this again and again. After the Great Depression, entire industries were rebuilt. Infrastructure expanded, manufacturing evolved. New financial regulations reshaped markets. After the 2008 financial crisis, technology companies exploded in growth. Platforms that seemed small before the crash became global giants. Digital infrastructure expanded. Online commerce accelerated. Entire industries shifted toward technology-driven solutions. Even during the pandemic crisis, massive economic transformation occurred. Remote work technology expanded rapidly. Digital payments accelerated. Online education platforms grew. Healthcare innovation moved faster than ever before. Crisis forces change, and change creates opportunity. The wealthy understand this pattern. While others focus on the destruction happening today, they focus on the industries that will dominate tomorrow. They ask questions most people ignore. Questions like, what problems has this crisis exposed? What solutions will the world need next? Which industries will grow because of these changes? The answers to these questions often lead to the next generation of wealth creation. Because when a new industry begins expanding, early investors experience extraordinary growth. But identifying those opportunities requires vision, the ability to look beyond immediate chaos and imagine the future landscape. For example, imagine being an investor in the early days of the Internet. In the 1990s, many people dismissed the Internet as a niche technology, something interesting but unimportant. But a few investors saw something different. They saw a transformation, a new infrastructure for communication, commerce, information. Those early investors built enormous fortunes because they recognized a shift before it became obvious. And the same pattern appears after every major crisis. New technologies emerge, new business models appear, new industries begin forming. The wealthy study these shifts carefully. They analyze trends. They observe consumer behavior. They track technological developments, because identifying the next wave of innovation can create enormous opportunity. But vision alone is not enough, because even when opportunities appear, fear can still prevent action. And during a crisis, fear is everywhere, which is why the final skill required to get rich during a crisis is not financial knowledge. It is not market timing. It is not even capital. It is courage. Dear viewer, please write in the comments what interested you most in the video. This will help us improve our videos. Chapter 22. Courage in Uncertain Times. Courage is not the absence of fear. It is the ability to act despite it. And during a financial crisis, courage becomes incredibly rare, because the environment feels unstable, the future feels uncertain, every decision feels risky. Most people wait for certainty. They wait for confirmation that the crisis has ended. They wait for markets to stabilize. They wait for experts to declare the recovery official. But by the time certainty returns, the opportunity has usually passed. Markets move before confidence returns. Prices recover before headlines improve. Opportunities disappear long before the public feels comfortable investing again. This is why courage becomes a decisive advantage. The courage to act when others hesitate. The courage to follow strategy instead of emotion. The courage to invest in the future while others remain focused on fear. But courage does not mean recklessness. It does not mean ignoring risk. It does not mean gambling on uncertain outcomes. True courage comes from preparation, from knowledge, from discipline, from understanding the patterns of history. When you understand how crises unfold, fear loses some of its power, because you recognize the pattern. You know panic will eventually fade. You know markets will eventually stabilize. You know innovation will eventually create new growth. And that knowledge creates confidence, not blind optimism, but informed courage. The investors who built wealth during past crises were not fearless. They simply understood something others did not. They understood that crises are temporary, but opportunities created by crises can last for decades. In the next chapter, we will bring together every principle explored so far: the mindset, the preparation, the strategy, the leverage, the vision, and the courage required to turn economic chaos into financial opportunity. Because understanding these principles can completely change the way you view the next crisis. Instead of fearing it, you may begin preparing for it. Chapter 23. The Crisis Wealth Framework. By now, a pattern should be becoming clear. Crises are not random chaos. They follow cycles. Human psychology follows predictable patterns. Fear spreads, markets collapse, assets become undervalued, and eventually, recovery begins. Those who understand this pattern do not simply react to crises. They follow a framework, a system that allows them to move through economic collapse with clarity. Let's bring the entire strategy together. Step 1. Expect the cycle. The first rule of crisis wealth is simple. Assume another crisis will happen, not because the world is doomed, but because cycles are part of the economic system. Booms create excess, excess eventually collapses, and collapse resets the system. Once you accept this reality, you stop being surprised by downturns. You begin preparing for them. Step 2. Build financial resilience. Preparation happens during prosperity, when the economy is strong, when markets are rising, when everyone feels optimistic. This is when the wealthy quietly build reserves. They maintain liquidity, they manage risk, they avoid becoming overextended because they know stability will not last forever. Step 3. Study value. When markets crash, prices become emotional. Fear drives selling, and assets temporarily disconnect from their real value. Those who understand valuation can recognize when markets are exaggerating risk. They know which assets remain fundamentally strong. They know which industries will recover, and they act when prices fall below true value. Step 4. Act during fear. This is the hardest step because crisis environments feel terrifying. Headlines become negative. Experts predict disaster. Confidence disappears. But historically, the greatest opportunities appear during the moments of greatest fear. The wealthy train themselves to move forward when others retreat. Step 5. Focus on ownership. Short-term speculation rarely creates lasting wealth, but ownership of strong assets does. Businesses, real estate, equity, platforms, intellectual property, anything that produces ongoing value. During crises, these assets often become available at extraordinary discounts. Step 6. Think long-term. The final step is patience. Crises do not resolve instantly. Recovery takes time. Markets fluctuate. Confidence slowly returns. But those who invested strategically during the downturn often experience extraordinary growth during the recovery because the assets they purchased at discounted prices begin regaining value. This framework is simple, but not easy, because following it requires emotional discipline, patience, preparation, and courage. Yet history repeatedly proves that those who follow this framework often emerge from crises wealthier than before, while others struggle to recover. Chapter 24. The next crisis is already forming. Here is a truth that may feel uncomfortable. The next crisis is already forming somewhere in the economy, somewhere in the financial system, somewhere in the cycle of boom and excess. It always is, because economic expansion always contains seeds of instability. Debt grows, speculation increases, confidence becomes excessive, and eventually something triggers the correction. But instead of fearing that reality, you can prepare for it. You can begin thinking differently, building resilience, studying markets, learning how assets behave during downturns, strengthening your financial foundation. Because when the next crisis eventually arrives, most people will experience it the same way they always have, with fear, confusion, uncertainty. But you will recognize the pattern. You will understand the cycle. You will see what others cannot yet see. Opportunity. You will see assets trading below their true value. You will see industries restructuring. You will see innovation beginning quietly during the chaos. And while others focus only on the destruction, You will be watching the transformation that always follows collapse, the rebuilding of industries, the birth of new technologies, the creation of the next economic expansion, because crises do not just destroy wealth, they redistribute it from the unprepared to the prepared. And now that you understand the strategy, the next crisis no longer needs to be something you fear. It can become something you prepare for, something you study, something you eventually use as a turning point in your financial life. But there is one final lesson, one final truth about wealth during crisis. A truth that determines whether all of this knowledge becomes theory or becomes transformation. And that truth is this: the future belongs to those who prepare before the opportunity appears. In the final chapter, we will explore the ultimate mindset shift required to truly benefit from economic crises. The way the wealthy think about uncertainty, opportunity, and long-term financial power, and why mastering this mindset may be the most valuable investment you will ever make. Please like and subscribe if you want a better future for your children, your family, and yourself. It's very difficult to achieve success today, but I'm sure you'll succeed. All you have to do is learn and discover new things. Chapter 25. The Mindset That Turns Crisis into Wealth. Everything you have heard in this audiobook leads to one final realization. Getting rich during a crisis is not primarily about money. It is not about luck. It is not about having perfect timing. It is about mindset. Because two people can experience the exact same economic crisis and walk away with completely different outcomes. One leaves poorer, the other leaves wealthier. Not because the events were different, but because their thinking was different. Most people see crisis as destruction. They see collapsing markets, job losses, fallen investments, uncertainty. Their focus stays locked on what is disappearing, and because of that focus, they react defensively. They withdraw. They avoid risk. They wait for stability to return. But the wealthy see something else at the same moment. They see restructuring. They see inefficiencies being removed. They see outdated industries collapsing. They see new technologies rising. They see value appearing where fear once dominated, where others see the end of opportunity. They see the beginning of it. This difference in perspective changes everything, because perception determines action, and action determines outcome. If you believe crisis equals danger, you retreat. If you believe crisis equals opportunity, you prepare. The wealthy do not celebrate crises. They understand the suffering they cause, but they also understand something deeper. Economic collapse does not stop progress. It accelerates transformation. New businesses emerge, innovations spread faster, new leaders rise, new industries are born. And the individuals who recognize those shifts early often become the architects of the next economic era. Think about the companies that dominate today's economy. Many of them were built during difficult times. Difficult environments force creativity. They force efficiency. They force bold thinking, and those pressures produce extraordinary innovation. The same principle applies to individuals. Crises reveal character. They expose weaknesses, but they also reveal strength, resilience, adaptability, vision. Those who learn to navigate uncertainty develop a powerful advantage, because the future will never be perfectly stable. Markets will rise and fall. Industries will evolve. Technologies will disrupt existing systems. But those who master the mindset of opportunity will always find a path forward. They will continue adapting, continuing learning, continuing building. And that mindset begins with a simple shift. Stop asking, how do I avoid crisis? And start asking, how do I prepare for it? Preparation changes fear into strategy. It changes panic into patience. It changes chaos into opportunity. When you prepare financially, you build reserves. When you prepare intellectually, you study markets. When you prepare emotionally, you strengthen discipline. And when the next crisis eventually arrives, you will not experience it the same way as everyone else. While others react with confusion, you will recognize the pattern. While others retreat, you will evaluate opportunities. While others focus on law, you will focus on value. Because the truth about wealth during crisis is simple. Opportunities do not appear because crises exist. They appear because most people are not prepared for them. But now you understand the pattern. You understand the cycle. You understand the strategy. And that knowledge alone already places you ahead of most investors. The next step is action. Begin preparing today. Strengthen your financial foundation. Study markets. Develop patience. Build your network. Expand your knowledge, because when the next crisis arrives, preparation will determine your outcome. Before we finish, take a moment to reflect. What idea in this audiobook changed the way you think about money the most? What lesson challenged your perspective? What strategy will you begin applying today? If this message resonated with you, share your thoughts. And if you want to continue exploring strategies for building wealth, financial independence, and intelligent investing, let us know what topic you would like to hear next. Because the journey toward financial mastery never truly ends. It only evolves. And remember this one final truth. Every crisis carries two possibilities: loss for the unprepared, opportunity for the prepared. The choice of which side you stand on begins today. Next chapter, the next time the world panics. Imagine this moment. A few years from now, the news flashes urgent headlines. Markets are falling again. Experts appear on television predicting uncertainty. Your phone fills with messages. Friends asking, what is happening? Is the economy collapsing? Should we sell everything? The atmosphere feels tense, unstable, uncertain, and millions of people across the world will experience that moment with fear. But if you remember what you learned here, you will experience that moment differently. You will pause, you will breathe, and instead of reacting emotionally, you will begin observing. You will look at the market. You will look at industries. You will look at assets. And instead of seeing chaos, you will see patterns. Patterns you already understand. You will recognize the cycle. The same cycle that has repeated for centuries. Boom, excess, correction, opportunity, recovery. You will remember that panic always looks permanent when you are inside it. But history always tells a different story afterward. Because every crisis eventually becomes a chapter in the past. The Great Depression felt endless. But new industries were born afterward. The 2008 financial crisis felt catastrophic. But technology innovation exploded afterward. The pandemic disrupted the entire world. But new digital economies accelerated faster than anyone predicted. Crisis destroys weak systems, but it also clears the path for stronger ones. And those who are prepared when that shift happens often find themselves standing at the beginning of a new economic era. That is why the wealthy never waste a crisis. They do not panic. They prepare. They study. They wait. And when opportunity appears, they move. The difference between panic and preparation is not intelligence, it is awareness. Awareness of how cycles work. Awareness of how fear distorts markets. Awareness of how opportunity hides inside uncertainty. And now you have that awareness. But knowledge alone does not create wealth. Only action does. The action to start preparing. The action to strengthen your financial foundation. The action to learn how money truly works. Because wealth is not built during a crisis. It is revealed during a crisis. Those who prepared rise. Those who ignored preparation struggle. So begin now, not tomorrow, not when the next crisis begins. Now. Build financial discipline, build knowledge, build patience, build assets. And when the world eventually faces its next economic storm, you will not be standing in the crowd asking what to do. You will already know, because crises do not create the wealthy. They simply reveal who was ready. If this audiobook gave you a new perspective on money, opportunity, and economic cycles, take a moment and reflect. Which idea changed the way you think about wealth the most? Which insight surprised you? Which strategy will you begin applying today? Share it. Because sometimes the most powerful ideas come from conversations. And if you want more deep dive audiobooks about building financial independence, thinking like the wealthy, mastering money psychology, and creating long-term wealth, tell us what topic you want to hear next. Your next idea might become the next audiobook. Until then, remember one final principle. A principle that has shaped fortunes for generations. The greatest opportunities rarely appear during comfortable times. They appear during moments when the world feels uncertain. And those who are prepared when those moments arrive often change their financial future forever. Chapter 26. The Silent Wealth Builders. When people imagine wealth being created, they often imagine dramatic moments, a lucky investment, a sudden breakthrough, a market prediction that turned out perfectly, but the truth is far less dramatic. Most wealth is built quietly, silently, slowly, while the rest of the world is distracted. The investors who become wealthy during crises rarely announce what they are doing. They do not broadcast every purchase. They do not argue loudly about markets on social media. They move quietly. They analyze. They accumulate. They wait. This silence is strategic because wealth creation is often boring. It involves studying businesses, reading financial reports, analyzing long-term trends. Most people do not have the patience for that. They want excitement. They want quick profits. They want dramatic success stories. But the investors who quietly build wealth understand something important. Fortunes are usually built long before anyone notices them. By the time the public recognizes a successful investment, the early investors have already spent years building their position. During crises, this quiet accumulation becomes even more powerful, because while the world is panicking, the patient investors are researching. While markets fall, they are identifying opportunities. While headlines scream catastrophe, they are building the foundations of future wealth. Years later, when the recovery becomes obvious, those quiet decisions suddenly look brilliant. But the brilliance was never in the timing. It was in the discipline. And discipline is something the wealthy protect carefully, because markets reward patience more than excitement. Chapter 27. The Power of Strategic Patience. Patience is one of the most underestimated financial skills in the world. In a culture that celebrates speed, instant results, and rapid growth, patience can feel like weakness. But In investing, patience is power. When a crisis hits, everything moves fast. Prices fall rapidly, news spreads instantly, social media amplifies fear. The environment pushes people toward quick decisions. But quick decisions during panic rarely lead to good outcomes. Strategic investors slow down. They observe. They analyze. They let the initial shock pass before committing fully, because the first reaction during a crisis is rarely the final one. Markets often overshoot in both directions. Prices may fall too far, then rebound too quickly, then stabilize. Patience allows investors to watch this process unfold, to gather information, to understand which opportunities are real and which are illusions. The wealthy do not rush into every opportunity. They wait for the right ones. The opportunities where value is obvious, where risk is manageable, where the long-term potential is clear, and when those opportunities appear, they move decisively. Strategic patience is not passive. It is controlled readiness. The ability to remain calm while others panic. The ability to act quickly once the right moment arrives. And this combination of patience and decisiveness is one of the defining traits of wealthy investors. Dear viewer, since you watched this video to the end, you are among the small percentage of people who can appreciate our videos. Please write your rating in the comments, whether you like the video or even what you would improve. We read every comment under our videos, so yours will not go unread. Thank you. Chapter 28. Wealth is built in downturns. There's a saying often repeated by experienced investors. Bull markets make you feel smart. Bear markets make you rich. When markets are rising, almost everyone appears successful. Prices increase, investments grow, confidence spreads. But during those times, it is difficult to distinguish skill from luck. Downturns reveal the truth. They reveal which businesses are strong, which investors are disciplined, which strategies are resilient. During downturns, prices fall, weak companies collapse, speculation disappears, and assets return to more realistic valuations. This environment creates something incredibly valuable: clarity. For the first time in years, prices reflect fear instead of hype. Investors become cautious. Speculation slows down, and patient buyers begin entering the market. This is when the foundations of long-term wealth are often built, because assets purchased during downturns frequently produce extraordinary returns during recoveries. But this only happens for those who remain active during difficult periods, those who keep studying, keep analyzing, keep investing, while others retreat. Because the best opportunities rarely appear when everyone is optimistic. They appear when optimism disappears. Chapter 29. The Discipline of Long-Term Thinking. One of the greatest advantages wealthy investors possess is perspective. They measure time differently. Most people think in days, or weeks, or months. The wealthy think in years, sometimes decades. This long-term thinking changes how they respond to crises. A market crash that looks terrifying on a daily chart may appear insignificant on a 20-year chart. Temporary volatility becomes less frightening, and long-term opportunity becomes easier to see. For example, consider the long history of global markets. Despite wars, recessions, political crises, and economic shocks, markets have consistently moved upward over long periods of time. Not smoothly, not predictably, but persistently. This upward movement reflects human progress, innovation, productivity, entrepreneurship. Each generation builds new industries, new technologies, new systems of value creation, and those who invest in that progress participate in its growth, but only if they maintain long-term discipline. Short-term thinking turns volatility into fear. Long-term thinking turns volatility into opportunity. Chapter 30, The Investor You Become. Perhaps the most important outcome of studying crises is not financial, it is personal, because learning how to navigate uncertainty changes the way you think about the world. You become calmer during chaos, more analytical during panic, more patient during volatility. You stop reacting emotionally to headlines. You start evaluating information strategically. You stop fearing economic cycles. You start preparing for them, and over time, something remarkable happens. You stop thinking like a consumer of the economy. You start thinking like an owner of it, an owner who studies markets, an owner who invests in progress, an owner who recognizes opportunity even when the environment feels uncertain. This transformation is the true beginning of financial mastery, because wealth is not only about money, it is about perspective, the ability to see systems instead of noise, cycles instead of chaos, opportunity instead of fear. And once you develop that perspective, every future crisis will look different. Not easier, not painless, but understandable. Because the investor you become after mastering these ideas will not be surprised by economic storms. You will be ready for them, prepared for them, and possibly positioned to grow because of them. Chapter 31. The Crisis Advantage. There is something powerful about difficult times, something most people overlook. Crisis removes illusion. During economic booms, almost everything appears successful. Companies grow, investments rise, even weak businesses seem profitable. But much of that success is temporary. It is inflated by easy money, optimism, speculation. When a crisis arrives, those illusions disappear. Weak systems break. Fragile businesses collapse. Unrealistic valuations fall back to reality. And suddenly, the market becomes honest again. This honesty creates an advantage for disciplined investors, because when illusions disappear, value becomes easier to see. Strong companies stand out clearly, solid assets remain stable. Innovative businesses continue solving real problems. Crisis simplifies the market. It separates speculation from substance. And for those who know how to analyze opportunity, this clarity becomes incredibly valuable. Instead of chasing hype, you can focus on fundamentals. Instead of following trends, you can evaluate long-term value. And that clarity allows disciplined investors to build wealth while others remain confused. Chapter 32. Building your personal crisis plan. If crises create opportunity, the logical question becomes, how do you prepare for the next one? Preparation does not begin during a recession. It begins long before. And the most effective preparation is a personal crisis plan. A crisis plan answers several critical questions. How much liquidity do you maintain? Which industries do you understand best? What assets would you buy if markets dropped 30 or 40%? Which opportunities would you avoid? When you answer these questions in advance, your decisions during a crisis become much clearer. You are not reacting emotionally. You are following a strategy you designed when the world was calm. The wealthy often maintain lists of companies they would like to own at the right price. They study industries for years before investing. They track valuations. They analyze competitors. Then when the market suddenly collapses, they are not scrambling to research. They already know what they are looking for. Preparation transforms chaos into clarity. Chapter 33. Opportunity hides. Where fear is greatest, human psychology creates a fascinating pattern in markets. People chase excitement. They chase growth stories. They chase industries everyone is talking about. But the greatest opportunities often appear in places where interest disappears, where fear dominates, where the headlines sound negative. During crises, entire sectors can become unpopular. Investors abandon them. Prices collapse. Confidence disappears. Yet some of those industries eventually recover stronger than before. Consider industries that seemed doomed during past crises. Technology during the early 2000s crash, banking after the financial crisis, travel during the pandemic. At their lowest points, many investors believed those industries might never recover. But over time, recovery arrived, and those who invested when pessimism was highest often experienced enormous gains. This pattern is not guaranteed. Some industries never return, but the possibility of recovery is precisely what creates opportunity. Because when fear is widespread, prices often fall far below long-term value, and disciplined investors search carefully in those environments. Chapter 34. The courage to be early. One of the most difficult things about investing during a crisis is timing. No one rings a bell when the bottom arrives. There is no clear signal that says the opportunity has begun. Markets often turn quietly, slowly, unexpectedly. This means investors who capture the best opportunities are often early. They begin buying before the recovery becomes obvious, before the news improves, before confidence returns. Being early requires courage because it feels uncomfortable. Markets may continue falling after you invest. Experts may still be predicting disaster. Friends may question your decisions. But waiting for perfect certainty usually means waiting too long. By the time everyone agrees that recovery has begun, prices have often already risen dramatically. The wealthy accept this uncertainty. They understand that investing during crisis involves imperfect information. So instead of trying to predict the exact bottom, they focus on value. They invest gradually. They build positions over time. This approach allows them to participate in the recovery without needing perfect timing. Chapter 35. The long game of wealth. Ultimately, wealth created during crises is not about one event. It is about playing the long game. One crisis alone rarely makes someone rich, but a lifetime of disciplined investing through multiple cycles can create extraordinary wealth. Consider an investor who prepares for downturns, who studies markets, who buys strong assets during periods of fear, and holds those assets through recovery, then repeats the process again during the next cycle. Over decades, that strategy compounds. Assets grow, income increases, opportunities multiply. Each crisis becomes another stepping stone, another chance to acquire value, another moment where preparation meets opportunity. This is the real secret behind many of the world's largest fortunes. They were not created in a single moment. They were built across cycles, across decades, across multiple crises. And those who understand this long-term game begin viewing economic downturns differently, not as disasters, but as chapters in the ongoing story of wealth creation. And if you continue studying markets, continue building discipline, continue preparing for opportunity, then the next crisis will not simply be something you endure. It may become something that accelerates your financial future. Chapter 36. The discipline of preparation. Preparation is not exciting. It does not create headlines. It does not feel dramatic. In fact, most of the time, preparation feels almost invisible, quiet, slow, routine. But preparation is the foundation of every financial breakthrough. Think about the investors who seem to move confidently during crises. When markets collapse and uncertainty spreads, they do not panic. They do not scramble for information. They do not rush into impulsive decisions. Instead, they act with calm precision, because their preparation happened long before the crisis arrived. They studied industries when markets were stable. They analyzed businesses when prices were rising. They identified opportunities long before panic created discounts. Preparation turns uncertainty into familiarity, and familiarity creates confidence. When you already understand an industry, when you already know which companies are strong, when you already know the prices you would consider attractive, the chaos of a crisis becomes easier to navigate. Preparation does not eliminate risk, but it transforms confusion into strategy. Chapter 37. Learning from every cycle. Economic cycles repeat, but every cycle teaches something new. Each crisis reveals patterns, mistakes, and opportunities. Successful investors treat every downturn as a classroom. They study what happened. They analyze which industries recovered quickly, which companies survived, which strategies worked, and which decisions failed. This continuous learning creates an advantage over time, because every crisis adds another layer of experience, another set of insights, another understanding of how markets behave under pressure. The first crisis you experience may feel overwhelming. The second may feel familiar. By the third or fourth cycle, patterns begin to emerge clearly. Fear becomes easier to manage. Strategy becomes easier to execute. Experience transforms uncertainty into insight, and insight allows disciplined investors to move with clarity, while others remain confused. Chapter 38. The power of staying in the game. One of the simplest yet most powerful principles of wealth creation is this: you must stay in the game. Many people exit the market permanently after experiencing losses. They sell investments during downturns. They abandon long-term strategies. They decide that investing is too risky. But leaving the game guarantees one outcome: you miss the recovery. Markets have historically moved through cycles of decline and growth. Those who remain invested participate in that long-term growth. Those who exit often struggle to return at the right time. The wealthy understand this principle deeply. They expect volatility. They expect downturns. They expect temporary losses. But they remain committed to the long-term process of investing, because wealth rarely belongs to those who avoid every downturn. It belongs to those who survive them. Chapter 39. Building confidence through knowledge. Confidence in investing does not come from luck. It comes from knowledge, from understanding how businesses operate, how industries evolve, how economic cycles unfold. When knowledge is shallow, uncertainty feels overwhelming. Every market movement feels unpredictable. Every headline feels threatening. But as knowledge grows, the environment begins to make sense. You understand why prices move. You recognize patterns in economic behavior. You develop frameworks for evaluating opportunity. Knowledge transforms investing from gambling into strategy, and strategy creates confidence. That confidence allows investors to remain calm during crisis, to analyze instead of panic, to act instead of retreat. Chapter 40. Becoming a student of opportunity, the most successful investors share a common trait. They remain lifelong students. They study markets continuously. They observe trends. They analyze businesses. They read history. They examine innovation. Opportunity rarely appears where people expect it. It often emerges quietly, in industries that are changing, in technologies that are evolving, in markets that are temporarily misunderstood. Those who remain curious notice these changes earlier. They recognize potential before it becomes obvious. And when crisis pushes prices lower, they are ready. Becoming a student of opportunity is not a one-time decision. It is a mindset, a commitment to learning, a habit of observation, a willingness to question assumptions. And over time, that mindset becomes one of the most valuable assets an investor can possess. Because knowledge compounds just like money. Each insight builds upon the last. Each cycle deepens your understanding. Each opportunity strengthens your confidence. And eventually, the world of markets no longer feels chaotic. It begins to feel like a system you understand, a system where patience, preparation, and discipline consistently create opportunity.